Over to you, Jeff.
All right, thank you all for tuning in to WGHC 98.3 FM, your voice, your music, your station. My name is Jeff Perdue, and I'm a licensed certified public accountant in the state of Illinois. I'm the owner and practitioner of my firm, Badu Tax Services, and my firm specializes in tax preparation, tax planning, and tax representation for individuals and businesses. So today, we'll be really talking about fundamental analysis. It's how to analyze a company's financial statements. I'll be talking about the different statements that are out there, as well as really how to use that information to your benefit. A lot of well-known billionaires actually use this concept in order to pick the top performing companies. And then throughout the presentation, I'll also be talking about how to tie this into your personal finance, because you'll find out that a company's finances are not that much different from your own personal finances. So you can really apply these same concepts and ultimately become prosperous and grow your money and think and grow rich. But before we do that, let's kick it off with a market week. This report is as of March 24th, 2017, so as of last Friday. And so what happened this week is uncertainty over Congress. Basically, they're having some trouble passing a new healthcare law, as well as prospects of additional interest rate increases. Really left investors confused last week. They were pretty confused as far as what to do, how the market is going to react. But overall, the S&P 500 lost over 1% last week. This is the biggest loss of the year so far. Overall, the market in general took a pretty small hit, not a big hit. Still no need to panic or anything like that. But S&P 500 lost over 1%. And then basically, the Russell 2000 fell over 2.5%, which puts it in negative territory this year. So far, year to date, Russell 2000 is performing pretty bad. And then, so late last Friday, the proposed American Health Care Act was pulled from consideration for lack of support, leaving the current Affordable Care Act in place for the foreseeable future. What impact, if any, this action will have on trading next week remains to be seen. So far this week, it's been a pretty mixed week. There is one thing significantly that happened today. And ultimately, so this report says that investors are likely to be watching the last GDP report of the fourth quarter to get a better fix of the economy. So GDP growth is actually at 2.1% now. It was forecasted at 1.9%. And so overall, that means the economy is actually doing pretty good. It's doing better than expected, actually. And so we have pretty good growth. This most likely means that the Federal Reserve will be increasing interest rates within the next few months or so, and throughout the rest of the year, like they've predicted. Remember, there's 3 total interest rate increases predicted this year. So far, 1 has happened, and they might actually just go up to 4. So what does this mean? Is that it will become more expensive to borrow money. And so knowing this, you might want to lock in your interest rates now. As a matter of fact, you should have locked in all your interest rates in the past. But you still have some time. Interest rates are still, quote-unquote, fairly low compared to what it's been historically. But you will definitely be seeing a lot of rate hikes this year with all the good things that are happening in the economy. And also, the Federal Reserve just has to keep up with inflation. And then another thing is the price of crude oil fell last week from basically $48.70 a barrel to $48.14 a barrel. And then gold went up. Typically when the market is down, gold goes up. And so gold went up from $1229.30 to $1246.40. And so overall, the economy, the market, everything is still doing pretty good. We did take a hit last week. But overall, there's no need to panic. There's no need to be worried about anything. Just because we're, according to forecasts, according to the data, the trends, nothing significant, nothing negative significant is going to happen over the next few months or so. So that's good news. But to get into the big topic for today, it's called fundamental analysis. It's a pretty big word, two pretty big words, but all it means is analyzing the company's financial reports. Just ultimately seeing whether it's a good idea to buy this company or not. And so, really, fundamental analysis can also help with your personal finances as well. And I'll be talking about the different financial statements out there as an accountant that went to school and that has experience over this stuff. I know firsthand what it means to have good financial statements and what all the different components of the statements. I'll be talking about it on a basic level because I don't expect anyone really to have extensive knowledge on this. But really breaking it down in very simple, plain English terms, hopefully it makes sense. Some of this stuff might be a little over your head as well, but understand that it is important. This is not a necessary component in picking companies, but you might want to do some sort of fundamental analysis before you actually buy a company, before you invest in a company, before you do anything really. It's good to keep track of a company's finances. As a matter of fact, all of the companies that I'm invested in, I actually take a look at their annual report whenever they get released each year. And so, really, as I was saying before, billionaires use fundamental analysis to choose which companies they believe will perform well. The Warren Buffetts, the Bill Gates, basically all the billionaires out there that trade stock or they buy companies, private equity or anything like that. They actually take a look at a company's finances in order to determine if this will be a good investment or not. And you can apply the same concept to your personal finances, meaning that if you see your finances going a certain way, if you see your balance sheet a certain way, you see your income statement flowing a certain way, then you can easily be able to correct it or improve it. If, for example, if you believe your expenses are too high, maybe it's time to cut back in a certain area. And so ultimately what this does, this fundamental analysis, helps you really pick and point what's going wrong ultimately and what's going well with a certain, either a company or yourself. And so public companies, whenever a company goes public, they issue an IPO to the public, stock that anyone in the world can purchase. And so public companies are forced, according to the SEC, they're forced to release financial statements to the public each and every year. So you right now can go and access Apple's financial statements. You can go and check out their balance sheet right now. You can go and check out Facebook, Google, Microsoft, Amazon. All of these different companies, you can actually go out and check them out and see what their financial position is looking like, their balance sheet, and ultimately what money is coming in, income, what money is going out, expenses, and then also what is their net income looking like. And so by analyzing or looking at some of these numbers, you can tell, you can be able to sort of predict where a company is going to go. And so if a company has negative earnings, for example, it's probably not going too far. Or if a company is not paying out as much dividends as they did in the previous year, that might not be a good sign. Or maybe they're making a big investment or something. So it's very important to actually track and sort of read some of these numbers because it ultimately helps you make better decisions about that company. And so companies have typically have four main financial statements. You have your balance sheet, your income statement, your cash flow statement, and then your statement of shareholders' equity. And so a balance sheet really is, it tells you where you are. At any given point in time, where are you? And so balance sheets are actually as of a specific point in time. Like, you should know what your balance sheet is today. where's your cash? What amount are your investments worth? Things like that. So these are all things composed of your assets, and so, or your balance sheet. And so your balance sheet is composed of assets, liabilities, and then shareholders equity or net worth, or the different fancy terms out there. And so an asset, an easy way to think about an asset is something that puts money in your pocket. It's something that generates a future. The formal definition is it's something that generates future probable economic benefit. And so, for example, you own a rental property that you rent out each and every month. And so that rental property itself is an asset because it's putting money in your pockets. It's putting income in your pockets. And so an asset is something that produces something for the future. It might not be now, but it will at least produce something for the future. Your biggest, one of your biggest assets is your cash, or the most liquid asset is cash. And then you have liabilities. Think of it as things that take money out of your pocket. So assets put money in your pocket, liabilities take money out of your pocket. Formal definition of a liability is something that results in future sacrifices of economic benefits. So think about a mortgage. That's a liability because you have to pay it each and every month, and it's taking money out of your pockets each and every month. Hopefully, the income that you're making from the mortgage, let's say it's a rental property, hopefully that's more than the mortgage. And so if your assets are greater than your liabilities, then you're creating wealth, you're creating net worth each and every month. And so another thing is shareholders equity or net worth. And it's very simple. You take your assets, subtract liabilities, and that's your net worth or your shareholders equity. So a balance sheet, what does it do? It tells you where you are at a specific point in time. It's quote unquote. So a lot of people say they're worth millions of dollars. Well, your balance sheet is actually or your net worth is actually what you're really worth as far as money is concerned, or as far as a quantitative amount. And so if your net worth is in positive territory, and that means you're doing pretty good. That means assets are flowing into your balance sheet, and liabilities are held lower than your assets. So the smart thing to do is whatever net worth you have, you try to invest that net worth. And so that's another way to think about it, is that let's say you have cash sitting in the bank, and then you have like a mortgage or something. Or let's do a better example. You do own a rental property. It's bringing in, let's say, $2,000 a month. The rental property itself is an asset. And let's say that rental property has a mortgage on it, liability. And so let's say that mortgage is $1,500 a month. And so really, and it gets a little confusing, and that $2,000 minus that $1,500 is actually your net income. To figure out your net worth is whatever the property is worth minus whatever the mortgage is, or the outstanding balance on the mortgage is. And that's what is really your net worth. And so now to take it down to the next level is the income statement. Very important statement. And so with the income statement, it's very simple. It's probably the easiest to understand. You have your income, money coming in. You have your expenses, money going out. And so you'll notice that typically assets generate income and liabilities generate expenses. And then once you take the difference of that, your income minus your expenses, you have your net income. And so that's money that can be reinvested, it can be saved, it can be reinvested into your assets. And Mr. Rich Dad Poor Dad, Robert Kiyosaki, what his recommendation is, ultimately what you do is you acquire assets, rental properties, that generate income. And then what you do is, once you've accumulated enough income, you reinvest it into more rental properties or assets. And so now you see the cycle repeating itself. Assets create income, income create assets. Assets create income, income creates assets. And then you just keep rolling and rolling and rolling and rolling. And then ultimately, hopefully you'll become a billionaire. And so that's how really the rich get rich, is that they acquire assets that bring income, and then they reinvest that income back into more assets, and then it just keeps repeating itself. And so really, if you think about an income statement, let's really think about it. So from the personal side, income, your paychecks or investment income or something like that. Expenses, your bills, food, groceries, any sort of thing like that. And so when you take your income, your salary or your paychecks, take your expenses, your bills, you should have something left over, which is net income or disposable income. And now, unfortunately, what most people do at this point is they go out and dispose of that disposable income. And so the problem is, if you're not reinvesting your disposable income to create more assets, to generate even more income, you'll sort of be stuck in a phase where all your money is going towards paying bills. And so that is one of the biggest downfalls of people in America, or just people in the world in general, is that they get money, income, and then they accumulate a lot of expenses. The problem is they don't reinvest that income back into assets that bring more income. And so what they do is they overspend, basically, and every month, instead of them having disposable income or money left over each month, they basically don't have anything. And so there's no money to reinvest back into the asset category. And so in order to grow rich, in order to be wealthy, you actually do have to understand financial statements. You have to understand how your balance sheet and your income statement work. If your income statement is generating positive income, then you should ultimately be reinvesting this income back into your asset category. And it doesn't just have to be rental properties. It can be retirement accounts. Like your 401k, for example, is an asset. It can be anything. It can be stocks. It can be bonds. It can be a car, or a car that you're using it for investment purposes. Remember, a car that you just own, that is a pure liability if you have a car note on it, because that car is not generating any income, so it can't be an asset. Remember, an asset is something that brings probable future economic benefit. If you're just driving a car without it producing money, it's not an asset, it's a liability. And it's also an expense. It's certainly not income. And so that's the problem with a lot of people, is that when they invest into liabilities, and the liabilities create expenses, and then the cycle continues, and then ultimately you file for bankruptcy, you end up in financial distress. And so in order to grow rich, in order to become wealthy, in order to pick a good company, you have to reinvest income into assets to create more income. And then you have my favorite, all-time favorite statement of all time. This is the most important statement out there. It is your cash flow statement. And so your cash flow statement, it lets you know where cash is going. For an individual, your cash flow statement and your income statement are really pretty much the same thing. But for a company, their cash flow statement is a pretty important statement. It lets you track the money. Where is cash going? Cash is king. If you can't track cash, then you can't really track a company. You have to be able to follow the money and follow where the money is going. So with the cash flow statement, you have three main components of it. You have cash flow from operating activities, cash flow from finance, or cash flow from investing activities, and then cash flow from financing activities. So we'll start with cash flow from operating activities. This is money that comes from the normal operations of the business. Amazon, for example, are they actually selling, they're buying and selling the products? Are they actually doing that? Or Apple, are they actually selling these iPhones? If I see a positive cash flow, I should see it coming mainly from cash flow from operating activities. The problem is, if I don't see that, then that means the company is not doing what it is set out to do. in other words, if a company is not generating money, cash flow from their normal operations, then I don't know what it is that they're doing. And so I would never invest in a company that has negative cash flow from operating activities. And ultimately, companies with pretty high cash flow from operating activities, they tend to do pretty well. It means they're focusing on their business. It means money is coming in directly from them buying and selling products or providing a service. So you want to invest in companies with a pretty good cash flow from operating activities. And remember, these numbers don't mean anything unless you compare it to something. Compare it to the industry. Compare it to the top, to similar companies. Compare it to something in order to analyze this company. And so it's very important. A company has to have positive cash flow from operating activities, or I don't really know what it is that they're doing. And so another way to think about it is if Apple was literally selling, let's say Apple had negative cash flow from operating activities. What that really means is that ultimately Apple is losing out from selling each iPhone. And so why would I want that type of investment? I want Apple to be able to sell iPhones at a higher margin, a higher profit, so that money is coming from customers, cash flow, cash provided by customers. And so ultimately you want a company that has good cash flow from operating activities. And then another thing is cash flow from investing activities. So that's the second component of the cash flow statement. And so cash flow from investing activities is money coming in or going out from investing in things. Now this one is not as important as cash flow from operating activities, because if a company has high cash flow from investing activities, meaning in the high positive territory, then that means that they're pretty big on investing in things, maybe that they're growing a lot of their money. What I would much rather see, though, is I would much rather see the company boosting their cash flow from operating activities with this investment dollars. And so I want that cash flow from investments, the cash flow that's coming in, to go into cash flow from operating activities. So basically, I want that investment, that money that they're getting from investments, to go into their operations, so that your cash flow from operations is showing up as a pretty significant amount. And then if a company has a negative cash flow from investing activities, all that means is that they're acquiring a lot of assets. Maybe they're buying a new building. Maybe they're doing something to create more cash flow from operating activities. Maybe they're hiring more employees. Maybe they're doing something to generate more cash flow. I like companies with a lot of cash flow. And Apple is actually one of the wealthiest, or Apple is actually the richest company in the world, in that it has the most cash, pure cash, just sitting there. And so what you want to do is, ultimately you do want a company that has pretty good just cash flow in general, but you want it to be in cash flow from operating activities. And I'll be talking more about Apple later on as well. And then you have cash flow from financing activities. So this is money from borrowed funds, money from investors, money from just anyone who's looking to finance the company. And so a high cash flow from financing activities can mean that the company's borrowing too much, meaning that they're over leveraged, meaning that their debt ratio is too high. And so what I don't want to see is a very high cash flow from financing from the borrowing side, so from the debt side. So it's very important to analyze a company's debt ratio. And debt ratio is just how much debt a company has compared to ultimately the income that's coming in. And so I don't want a company that's just borrowing money and that's how they're showing positive cash flow overall. I want a company that's showing positive cash flow from operating activities. That way I know that they're actually doing what they're out set to do. And if they're doing good on a positive cash flow side, from operation side, then that means that they're probably going to produce more. And so I like companies with high cash flow from operating activities. And then if they're issuing too much, if they have a very high cash flow from financing, it can also mean that they're raising too much capital. Or it can be a good thing. It can also mean that they're looking to raise funds for people as well. And then also what you have is, so overall, a company with good cash flow should have money from the operations. And you should always pay attention to the breakdowns instead of looking at the amount as a whole. You don't just want to look at cash flow just in general. You don't just want to look at the cash flow statement and then see what the net cash flow is. You want to see the broken out parts. And so cash flow may be positive, but it ultimately just might be coming from borrowing money. And think about your personal finances. If you're in positive territory, doesn't mean that it's coming from your salary, your operations, or doesn't mean that it's coming just from borrowing money. And then you have the shareholders equity statement. Not too important, but it does help you see how much you would get paid, or it lets you know how much investors are raising and things like that. And so it's very important to understand these concepts when investing for the long term. If you're doing short-term investing, it's not that important. If you're a day trader, you can care less about cash flow from operating activities or any of this stuff. You're just looking to speculate the market. But if you're in it for the long term, the Warren Buffetts, the Bill Gates, you need to do some sort of fundamental analysis before you actually invest in a company. And then they can always relate to your personal finances. Business finances are not that much different from your personal finances. And a company with a lot of assets might be a good sign. It might be they're in healthy territory. And then a company with too much cash on hand, that can be good and bad for investors, because it can mean large payouts for investors, or it can just mean that they're not investing enough. They're not putting money into the R&D or research and development. They're not putting enough money into that stuff. And so, like I said before, Apple is the richest company in the world. They have a ton of cash on hand that can either be reinvested back into the company to produce more iPhones, more iPads, or it can be paid out to shareholders. Apple actually increases their dividends 10% a year, and they've basically guaranteed that for a very long time. And as an Apple investor, I know that they actually do pay dividends pretty well. And then a company with negative profits can be a sign that the company is struggling. So you probably don't want to invest in that type of company. So a company with good CFO or good cash flow from operating activities, lovely company. You definitely want these type of companies. And then always pay attention to how a company is performing, how you yourself are performing, based on your financial statements. Always do a quarterly checkup on your personal finances. See where money is going, see where money is coming in from, where money is going out. Is there room to improve? And then always follow the money. Cash is king. You always have to follow the money. Always see where the money is actually going. And then ultimately just apply these principles to your personal finances. And you should be able to prosper if you're tracking your finances. You know, it lets you know if you're spending too much. Lets you know if you're saving too much. Lets you know if you're not investing enough. Lets you know all these things. And then the two main financial statements for an individual. You have your statement of financial position, which is your balance sheet. And you also have your income statement. And so really that's it. That's it for the presentation. Thank you guys for tuning in and listening. And I hope you guys will be tuned in next week. And I definitely appreciate it. And so next week I'll be talking about some more topics. And then throughout we'll be talking about similar stuff. And I really hope you guys are gaining some knowledge and some wisdom from the financial literacy that's being applied on this radio station. So thank you guys once again.
That is the Honorable Community Accountant, Jeff Badu. Another segment from the money man himself, the financial guru. It's Money Talks right here on Voga every Thursday from 7:15 to 7:45-ish. Sometimes I give him more minutes, because the education is needed. I hope, sir, Niawati over to me at the show how far. Well, investment business. At the last part I had businesses that are negative. What about organizations? Organizations is a business, right? Non-profit is still a business.
Yeah, well, that means we gotta invest more money.
Yeah. So if a non-profit is in the negative, does that mean that you can't? Can you even invest in a non-profit organization? Can you invest? Is that?
I mean, you can invest, but it can't really be for like profitable purposes.
Right. What? You can invest like with time and your
you can
insight.
invest your time, your insight, and I mean, at the end of the day, it's a write-off for you. So.
It's a write-off for you, right. But what about funding? Like, can you put money in a non-profit organization to help it stand on its foot, and maybe you still get the underwriting, and it just what can that take you? Besides the underwriting, if you invest your money into, if you donate, if you sponsor, like for instance, say Nigerian community or Ghanaian community, like we have the GNC or even this radio station, and all of that. Besides the underwriting, where does it take you when you put your money in? What can you get from it? I know that there's no profit, but what can you get from it?
You're getting a positive cause. For example, funding this radio station is funding the financial literacy and improving the community. And so ultimately, you're investing into something that can grow bigger for the community. You're investing in knowledge, resources. You're producing something. So you are getting a financial benefit on your tax return ultimately. But you might not.
Say that again. Say that again for that. You are getting the benefit from your tax return, right?
Yes, definitely.
Yes.
Oh, I've seen some big differences from just donating the money.
Big difference.
Oh yeah.
Then but your sakebium. So what to me donate the boy GNC, WGAC, any non-profit organization, you can see the benefit from your tax return.
Definitely. Easily. Very easily.
Very easily.
Some people need it. I would definitely do it. And ultimately, you're putting money into it, you're getting a benefit on your tax return, and you're doing something good for the community. And hey, maybe the good Lord will bless you with something even bigger.
But for profit, then make sure you check if the company is in the negative. It's a no-no. But let's go further. What about, say, you want to go invest in, in Ghana, Nigeria, Togo, or where you want to go invest from your motherland, from some companies in Ghana, and does the same policies or the same education that you just gave, does it apply internationally if you want to, do international business?
Yeah, it definitely applies internationally, because the purpose of any investment other than a nonprofit is to make profit.
Definitely.
If the company is doing bad, you're probably not going to make that profit. So you should always invest in things that grow your wealth and grow your income. I personally would never make an investment other than for charitable purposes unless that investment produces me more benefit than what I've invested.
Once again, the money man himself, financial guru, Jeff Badu, every Thursday right here on WGHC. And if you want to follow Jeff Badu, it's very simple. He has all his social medias out there. Hashtag Jeff Badu. Badu Tax Service LLC. You'll find him there. You have, I saw now one of the photos of me who were Facebook. So now, some seminar, some panel discussion. How did that go? What was that about?
Yeah, I mean, it was pretty good. I do a lot of financial literacy stuff. I do a lot of seminars. I talk throughout the country on personal finance.
Okay.
It's just something that I love doing. I wake up, practicing all the different things that I'll say. and it's really fun. It's
Yeah.
going really well.
Yeah, yeah. Kudos to you, my boy, and you are doing great. You are. This is the more reason why WGAC is here, exposing our professionals, such as Jeff Badu. You know, bringing it out there. You might not know that the community, we are blessed. We are blessed. We have a lot of assets. We have a lot of professionals among us that we need to know. Their resources will be beneficial to the community, to us, the community members. So, you know, that's why we are here. We are exposing. If you have anything, if you're in any field that you want to come out, please feel free. Come out. Let's expose you. Bring it back home. You know, give it to your people. Give it to your people. Today, I had the honor to meet a lot of African entrepreneurs and businessmen and women in the community. We met at the Ethiopian restaurant, and it was a very good networking. So, once again, kudos to you, Jeff, and next week Thursday, we'll see you.
Yes, sir.